I'm here to present a listed private equity fund tonight. Many of you may have heard of HVPE or HarbourVest before. Some of you may be shareholders already, in which case, thank you very much for your support. I'm going to struggle here because we have so much content and 20 minutes is never enough. So I'm going to just focus on some of my slides, not all of them. As we've already said, you'll receive copies after the event, so you can look at the detail and feel free to ask questions. But I'll start on a slide that shows you the kind of key numbers associated with our fund to introduce it to you. We have a portfolio of $4.3 billion invested into private companies. So the essential elevator pitch here is you buy a single share in HVPE, you open up access to more than 1,000 material private company investments. Now those are spread across all stages of a company's development. So we have seed venture funds that focus on very early stage companies that may be pre-revenue even, certainly pre-profit. We have later stage venture where the business is better established but still very new and potentially untested. And we have growth equity, buyout investments which kind of progress up the maturity curve right through to very established businesses that are household names. So there's a full range in our curated portfolio, very carefully constructed, to try to reduce risk. We're trying to capture growth opportunities whilst reducing risk. We are in the FTSE 250 index and have been for 9 years. So we are liquid, particularly by the standards of investment trusts and companies. So we typically see around £5 million worth of shares traded per day. Our market capitalisation is around 1.9 billion sterling. So we're the largest listed private equity fund of funds in London. And that does give us an edge for investors who want to be confident they can sell at some point to realise an investment. Now, those who follow the listed private equity sector may be aware that we trade on a wide discount to net asset value, currently 40%. Despite that, and I'll go into some of the reasons for that later, despite that, the total shareholder return over the last 10 years, if you'd simply bought the shares 10 years ago, held to today, you would have seen a return of 268%, which puts us at number 19 out of 260 AIC-listed investment companies of any type with that sort of track record. So the top decile return in terms of shareholders, actual own return, even though the discount is wide and has widened over that period. So how have we done that? It's clearly the portfolio. The portfolio has grown in value by an average of 13.2% per year in US dollars. That's our compound growth rate over the decade. That doesn't mean, of course, that every year we grow by 13%. It's the average. So there have been ups and downs. We had particularly strong years in 2020 and 21. And we've struggled a little bit recently because of interest rate rises and the effect that public market declines had on valuations. But we have certainly proven resilient through the difficult times we've just been through. The 13.2% average NAV growth is a 3.9 percentage point premium per annum over the FTSE All-World Total Return Index. So really our raison d'etre as a private equity focused fund is we need to outperform public markets. If not, then frankly, why would anyone look at the shares? So at the NAV level, 3.9% per year at the moment of clear outperformance. That's after all fees and costs, of course, have been deducted. So I'll spend a little bit of time on the structure, not too much, but this does differentiate us from our peers because we, as an investment company, we're effectively a client of HarbourVest Partners, which is a global private markets manager. So we invest alongside sovereign wealth funds, insurance companies, and other large investors who you may know, endowment funds invest in private equity routinely. So we are effectively alongside those same investors. We're making commitments to HarbourVest funds. Now, HarbourVest manages 3 main types of fund, but focuses on fund of funds investing. So I won't go through all the detail of that, but essentially we're gaining access through HarbourVest Partners to multiple underlying partnerships that are managed by names you may have heard of. So the best known private equity managers are probably the large US groups like KKR, Blackstone, EQT in Europe, and some of the venture funds like Index Ventures, Accel Partners, etc. So you have access through this listed structure to those kind of top performing general partners, as we call them, the managers of the actual underlying businesses. And so at the bottom layer, you have that exposure to 1,000 material private company positions. Now, in terms of the diversification in the portfolio, we do take a top-down approach in terms of our asset allocation targets. So we commit to various funds with a view to achieving a certain level of exposure by stage, i.e. the level of development of each company, by strategy, the route through which we access those companies, and by geography. So we do try to provide a very well-balanced, total return-oriented portfolio through the funds we commit to. So going through each of these in turn, buyout funds, for those who may not be familiar, though, the term buyout simply means a private equity manager is literally buying a business, taking control of that business, usually with an equity stake of more than 50% and sometimes 100%. And they will effectively manage that business. They will run that business. They'll hire and fire the CEO, CFO, all the senior management. So in a way, it's one way to think about it is, you have passive investing, which is just purely replicating an index or, a theme. There's active investing, which is stock picking in, traditional funds where the manager is looking at listed securities and selecting those. And then there's kind of really ultra activist, which is where private equity is. We're actually getting involved in the day-to-day of running those businesses, and that's a much more intensive model. That's the source, essentially, of the outperformance that we deliver. So that's 60% of our fund. Venture and growth equity are 31%, so those are the earlier stage opportunities where perhaps there is potential for faster growth but more risk. So we keep that to a very much a minority position in the portfolio, but still of a scale that we can really benefit from some of the top names that we have exposure to. So historically, to go back quite a way now, I mean, we were early investors in Uber, for example, back years before the IPO, through our venture and growth equity portfolio. Today we have Klarna, we have Revolut in the portfolio. So this vehicle is a way to gain access to those opportunities that frankly are not available to the majority of investors. And then finally, mezzanine and infrastructure, I won't spend too much time on. That's a yielding component of the portfolio designed to offset some of the volatility in the venture and growth equity side. Moving to geography, we try to replicate roughly the sort of allocation you'd see in a global public market index like the FTSE All World or the MSCI All Company World. So the US is the largest single geography, 62%, including Canada. Europe at 22%, Asia at 14%, and then rest of world. We don't have a deliberate target, but some of the funds do end up investing in some companies outside the traditional developed markets. By industry, you'll see a broad spread of exposure. There's no kind of top-down strategy as such. We're trying to be well-balanced by sector. Having said that, we do have an overweight to technology and software at 33% of NAV. That's really a function of the venture and growth equity exposure, but also in the buyout space, there are technology-focused companies that we also back. And then on the bottom right of the slide, you'll see a colourful ring chart. The idea there is we're trying to show some of the more exciting kind of themes that we have in the portfolio within the venture and growth space. And those companies are often early stage, promising opportunities that have yet to really grow in terms of value. So they may not be more than 0.2 or 0.3% of NAV now, but some of them may end up as 1 or 2% of NAV in a few years' time. Now, in terms of updates, I'll kind of try to be quick here. For current shareholders, this may mean more than for those who have yet to look at this in more depth. We do, because we're a closed-end fund, we need to be very careful about our balance sheet and liquidity. We've seen negative cash flow in the portfolio in recent years, which we always expected to see. So we've had a a large credit facility in place for many years now. We started off at the IPO in 2007 with a $500 million credit facility. We now have a $1.2 billion credit facility. So that's scaled with the size of the fund. And it gives us flexibility to continue investing within reason. We're very careful and prudent in the way we do it, but continue investing even through tougher market conditions. Year-to-date NAV per share growth, we haven't had much time so far year-to-date in terms of our own reporting. There's a lag in the valuations. But nonetheless, we've already delivered a positive return of 3%. So we're seeing a return to growth in our portfolio. And I'll skip a couple of these, but we're buying back shares quite actively. And regular investors into investment companies and trusts will know that's a big topic at the moment in terms of returning capital, delivering that NAV per share accretion at a 40% discount. It makes sense to buy back the shares. We cancel those shares, so you benefit from the NAV per share growth from those transactions. We've also, further to that, introduced a distribution pool mechanism. So there's a lot to say there. I will cover it very briefly on the next slide. The essential point I want to leave you with is, we're expecting a recovery in the private market space. We're expecting cash flow to turn positive at some point. And until then, we're supporting the share price by distributing capital, mostly through buybacks at the moment. So we're essentially, there's a lot of detail here, please don't worry about the detail, but we're allocating 15% of all the cash flow that comes in from maturing assets to a distribution pool, which is managed by the board. So the board is fully independent. They will decide based on prevailing market conditions, based on the opportunity set we see, and other factors, shareholder sentiment, whether to tilt towards share buybacks, which they are at the moment, or perhaps a special dividend, or even reinvestment at some stage. So if the discount narrows to a very much narrower level than today, it's possible the board would decide to allocate away from buybacks towards new investment or dividends. So the important point to get across here, I've only got 5 minutes left, is that we are expecting the distribution pool across the 2 calendar years, 2024 and 25, to amount to up to $250 million. So the idea there is we're supporting shareholder total returns by allocating capital most efficiently. The board is making those decisions on a month-by-month basis in terms of how to deploy that capital. And we as the manager are ensuring we're in a position to contribute that capital to the pool. And then the credit facility I've already discussed. Let me quickly go on to a market slide. So just to address a question that may be lurking in many people's heads, why should I be interested in private equity at all? I mentioned we have outperformed the public market, but actually the industry as a whole also tends to outperform public markets, measured against the MSCI All Company World Index, as we do here. So these 3 lines, the middle mid-blue line is measuring the multiple of the return delivered by the MSCI All Company World by the average private equity fund, if you select at random. And you'll see in recent years it's been hovering around 1.2 up to 1.4 in 2017. The line above that is the top quartile performance. So at the top 25% level of performance in the market, how is private equity outperforming relative to the public markets? So if you pick the best managers, in other words, you'll get quite a material outperformance of up to 1.74 in 2017. So that shows you we're investing into an industry that does outperform, and in turn, we're selecting managers that tend to be in the upper quartiles. This is our performance, to be fully transparent, on an annualized basis. So looking back to 2013, the bars show you the net asset value per share, and the green line shows you the share price. So clearly, very strong growth from 2013 to 21 and 22. And then we've plateaued to some degree, just starting to return to growth now. Let's bear in mind, we had NAV growth of 30, 37%, 40% in those 2 best years, 2021 and 2022. And so we haven't really given that back because we've seen parts of the portfolio that did less well in that period actually coming back into stronger returns, so real assets and private credit in particular. And then venture and growth equity that did spectacularly well before the interest rate rises, they have given back some of the gains. We've seen some write-downs in those portfolios. But the diversification means the overall NAV has been quite stable. I'll skip through these, they're a bit technical for the time left. I will just touch on HarbourVest Partners as a manager. Ultimately, it's worth remembering, whatever your skepticism around the share price, listed investment companies, whatever's happening in the world today, there are billions of dollars going into HarbourVest funds every year at par value alongside HVPE. Our shares are trading at a discount. We're still committing to those funds in the same way as other investors. So institutions are investing at par value. There's an opportunity through the listed fund for individual investors to buy at a 40% discount to those valuations. So whatever your view, that's quite a buffer, frankly. Whatever might happen in the next few years, you have that protection essentially of the discount. HarbourVest has been around 41 years. It has $125 billion AUM. So the investment company is effectively $6.5 billion of that. We're one large client of the firm. We have a team of 1,200 people around the world, 230 investment professionals, 13 offices, truly global reach on the ground. So we are very well qualified. We're specialized in private markets. We have average industry experience of 25 years at the managing director level. And so, it's a true partnership that works together for investors. And then I'll be very selective now. I've got 1 minute left. Vintage diversification. This shows the split of the portfolio by year of investment. So what marks us out, aside from diversification by geography, strategy, and stage, is that we do not have overweight exposure to any one single vintage year. So you might say, in hindsight, perhaps prices were higher in 2020 and 21. We didn't invest any more than normal. We simply averaged in, as we normally do. So you can see the blue bars are the most recent figures. The largest individual vintage year is 13% of NAV. So you don't have any skew in the portfolio. Some trading information. I'm on to questions in 30 seconds. An example of disclosable companies. Hopefully, you will have heard of the first one, I'm sure, Shein as our top holding. That grew out of a venture portfolio. So it started off as a small exposure. It's now our largest holding. That could IPO in the next few months. Below that, I suspect you haven't heard of any of them. And frankly, that's part of the raison d'etre here. We're providing access to a diversified private company portfolio that is not accessible on the public markets and to companies that you will not have heard of, and perhaps you will at some point when they grow. I will leave it there. I'll just skip to the key messages. Actually, I'll end on this one. Listed PE has lagged almost everything else that could be viewed as being related to listed PE. So clearly the public market in general, since May 2023, just taking a period of just more than a year here, you can see the LPCR listed funds in green. That just means the listed private equity segment of the UK stock market. Compared to almost everything, UK tech trusts that invest in listed technology shares, they've done better. US private equity managers, they make money by managing assets of the type we're invested in. If the market thought that those assets were not going to perform, the fee stream would be expected to potentially decline, and those share prices might decline. They haven't, they've gone up. You see all of the NASDAQ, the S&P, and the Euro stocks are way ahead. So I would say, you were right, it was this slide. So I'll leave you with that final message. We've got a quality portfolio. We think there could be latent value there. We haven't seen NAV growth keep pace with public markets in the last 12 months. And what more can I say? It's we're almost frustrated by the environment we're in with the London listed market, and we hope that at some stage we get the recognition we hope we deserve. So I'll go to questions now.
Thank you very much indeed. Thank you. So do we have any questions for Richard, please? Remember, put your hand up and we'll bring the microphone over to you. Looking around the room, I'll one here. I was going to kick off. Thank you, Steve. And then Steve, if you have another microphone.
Yeah, thank you very much for the presentation. Can you talk a bit more about the discount to NAV? You said you'd expand on that, but you didn't give too much detail.
Yeah. So I suppose kind of pre-COVID, back to a period of normality, the discount tended to be between 15 and 25%. That had become normal, I think, in the years after the financial crisis. Before the financial crisis, listed PE traded at a premium. So there was a view that actually it's going to outperform public markets, so why as investors wouldn't we pay a premium? But that narrative was kind of put on the back burner, I suppose, after the financial crisis, and there was just this psychological expectation of a discount in listed PE. There are a couple of funds in the sector that trade at par or a premium, so 3i notably trades at a premium. It's quite a different kind of structure, FTSE 100 and very concentrated portfolio. But that is again a different story. HG Capital trades close to par value, so it is possible for a structure like this to trade, at par or even a premium. But 40% in our case today is wider than even the normal range we saw kind of pre-COVID, and it's we widened out to 50% at the worst point in recent years, and we've started to claw back some of that, but I think there's still clearly room to make progress.
Can I just ask, Richard, before you move on, in terms of the rest of the peer group, you mentioned a couple that are trading near NAV, but 40% relative to the other listed PE funds, it's pretty typical? Or
pretty wide. The fund of funds are typically 30 to 40%, and we're at the wider end of that. It's a short-term thing. The discounts flip around, all the time. But in terms of causes, I haven't really addressed that. I think the lack of enthusiasm for UK stocks in general, the FTSE 250 is viewed as a domestic index. Our portfolio is 95% ex-UK. It's a global portfolio. There's no rational basis for our shares to sell off with domestic UK stocks, but because we're in the index, that happens. There is a cost regime in the UK, in the investment trust world, that is unhelpful to alternative assets in general, but particularly listed PE, infrastructure and real estate, because we have to include all sorts of costs in our disclosures that open-ended funds do not. So that puts us at a disadvantage. And I think there have been non-investment reasons why some shareholders have sold. So institutions have tended to want to reduce concentration levels for liquidity purposes, so large holders have tended to move out of larger funds like ours and into a larger number of other funds. So there are lots of reasons. There's probably still some skepticism over NAV because we've held up very well, and I think there's probably a kind of degree of unhelpful press comment around private equity and private credit, whereby the sentiment is negative. And investors are wary because, frankly, it's an asset class that's a little bit opaque. It's more difficult to understand maybe than some others. But I do think the discount in the short term, there's no real rational basis for the level of discount we're at.
Question here, please.
Yeah, sorry. I think I attended a private equity forum or online with Goodacre at the beginning of the year, and you were very much pressed on why you don't give a dividend. Now, I'm not sceptical about the market. I'm invested in three. You've got the widest discount and you don't pay a dividend. The others, Apax, 30% discount, and PEYE Partners, 25% discount. They both pay a dividend. So I would say that if you introduce a dividend, you might get more people who want to buy your shares. Would you like to comment on that?
Yeah, happy to comment. So we have actually consulted our shareholders on that question. So we went out at the end of 2023 before we introduced the distribution pool, and we did ask the question, what would you prefer, frankly? And some shareholders absolutely did say dividends would be the preferred option. On balance, there was more support for buybacks at that stage. And that could change, of course, if the discount narrows. But I think the NAV per share accretion argument from buybacks is kind of one that many shareholders are impressed by, and they would rather see that kind of capital gain. Now, clearly, that could change as well. There are tax incentives that skew that, and if that changes in the next few weeks, clearly, perhaps the views would change again. And I think the important thing is, the board will consult shareholders regularly on the question.
Question.
I wondered.
Yeah.
I wonder if I could ask you to comment on your view of the political position, particularly regarding the carry trade and the apparent dislike of our newly minted government for private equity.
I shouldn't comment on that specifically. I'm afraid I'm kind of restricted in what I can comment on. I think you're referring to carried interest, the taxation of carried interest, and that would be captured by the capital gain issue. So I won't make a comment other than to say I think these shares represent good value under any plausible scenario that we've kind of projected.
I had a question for you, Richard, about the underlying companies in the portfolio and how you manage duplication with the different funds that you're invested in. You have thousands of different companies. Do you look down at the individual company level or do you expect the managers to work out the duplication amongst them?
We do look right down to the portfolio company level. There are some instances where we have exposure to one company through more than one manager. That does happen. But that can be quite useful. We are never really at risk of having an over-concentrated holding, given most of our individual companies are sub 0.5% of NAV. It can be useful to have more than one manager invested because we'll often get two views on the valuation, two independent views, and that can be quite helpful in certain situations. So it's not something we worry about. I mean, we are very diversified quite deliberately. We think it brings many benefits.
The other question I had was about the geographical split. If you're seeking to outperform the index, why would you replicate, broadly speaking, the geographical split of an all-world index?
Well, we're trying to outperform based on the private markets investments and the fact that we're hopefully selecting the better managers within the industry. So we're not trying to outperform by taking a view that Europe will outperform Asia or some other kind of top-down macro strategy. This is really what we're trying to do is give shareholders a global portfolio that roughly is in line with a global portfolio in public markets, but outperform through the strategy we're operating.
Understood. Any other? It says time up, I'm afraid. Are you going to stick around afterwards for a drink, Richard? Are you going to be around?
Not sure we can, unfortunately. But,
we're not sure. We're not sure. I'm afraid to have to cut Richard another time. Thank you very much for joining us.
Okay.
Thank you for presenting. Thank you.